Happy Wednesday out there, friends. It's Darius Dale here to present our macro minute for Wednesday, June 29th, 2022. Starting with markets, we have stocks down this morning, commodities up, crypto down, dollar up, global bond yields mixed with U.S. rates leading, European rates lagging. Market moving headlines. The Fed needs you to capitulate on your summer travel plans, on your long equity and crypto holdings. It needs you to capitulate in order to get inflation under control. And what I mean by capitulate is we do need to see a significant slowdown in growth and or a recession to crush the back of inflation, which is very clearly the Fed's mandate, very clearly the Fed's stated objective. We got Jerome Powell and Christine Lagarde speaking in Portugal today against a challenging backdrop. Loretta Mester, the Cleveland Fed president, who's done a tremendous amount of work on inflation herself, her bank is advocating for a 75 basis point rate hike in July. That meeting's, I want to say, on July 27th. She said she wants to see rates breach 3 to 3.5% this year and a little bit above 4% next year. That 4% would be higher than the peak terminal Fed funds rate pricing, which is around 3.8% in the Eurodollar curves, peaking in around December. The Fed is, quote unquote, just at the beginning of raising rates, she told CNBC. Her baseline forecast is for the economy to slow this year, but not slip into recession. So again, you continue to hear a lot of the same commentary out of Fed officials, Bullard, Powell, et cetera, about recession is not the base case scenario, but what is the base case scenario is plowing ahead with rate hikes and quantitative tightening. We talked about the potential for an upside surprise in core PCE today in the leadoff morning note with the full array of data and sort of analysis in terms of the probable outcomes from a financial market perspective on a potential upside surprise. It's not necessarily what you think, so go check that out. Somebody always knows something on Wall Street. So today, JP Morgan cut earnings estimates across big tech stocks. I'll finish this comment. I had a quick thought. Let me read this. JP Morgan cut earnings estimates across big tech stocks, especially with those exposed to online advertising. That's usually communication services sector stocks. It lowered estimates on price targets for Snap, Google, Meta, Pinterest, Criteo, never heard of them, and Cardlytics, and cut price targets for Amazon, eBay, and Farfetch. Still, the firm said Amazon should gain retail share in a recessionary environment, given low prices, wide selection, and fast delivery. So a couple things here. One, my man Marko Kolanovic, who's historically been a pretty good strategist on Wall Street, obviously a very bright guy, really widely followed, is arguably the most bullish person on Wall Street. He's consistently called for the market at the bottom. He said that in May. I think he said it in April too. He's talking about the market recovering all of its losses by the end of the year, yet they're cutting price targets and earnings estimates. So that's pretty interesting. That dichotomy is head scratching. But one thing I'll say is that we obviously saw a pretty big smackdown in tech yesterday. I think the Nasdaq was off somewhere around 3%. Ahead of this, and this is the kind of stuff that really drives me crazy when you see this kind of stuff on Wall Street. Somebody knew these earnings estimates were going to get cut. Somebody knew these price targets were going to get cut, and we saw the action impact financial markets yesterday in a major way ahead of this pretty big announcement. So shame on you, Wall Street. We'll keep moving here, but we did 42 macro, not knowing anything, not just using the math, using the data. We did our model, our crowding model, which has been a rock star all year in terms of generating actionable trading ideas for those of you who like to have higher turnover in your portfolios. We issued a sell signal on tech, shorter term sell signal on tech back on Monday. Nasdaq 100 was overbought on Monday as well on our probable range process. Go check this program. So you don't need inside information. You don't need to guess to make money in financial markets. Just rely on the math. Our math is not perfect. We're not going to be 100% in terms of generating signals, buy and sell signals, but we are going to be better than bad consistently. And that's the whole point of the name of the game, is to minimize drawdowns, continue to compound returns by by betting on high probability outcomes on a consistent basis. That's what we do. I think we do that as well as anybody sitting on this side of the table on global Wall Street. And then lastly, sign of the crypto times, the market for non-fungible tokens, NFTs, such as the artwork or Bored Apes, is on course for its first month with less than $1 billion in sales since June of last year. That's a year, according to DAP Radar. Who the hell is DAP Radar? Anyway, British Virgin Islands court ordered a struggling crypto hedge fund, Arrows Capital, into liquidation. Sky News reported. So we're in the liquidation phase. We were obviously in the crisis phase when you go back to the Luna Terra debacle and I apologize. I can't keep up with all these names. But anyway, there was the other debacle recently with the liquidation. Now you're seeing crypto hedge funds liquidated. We're early in that process. The liquidations start and they cascade and build upon themselves into more liquidations. I mean, you go back to 2007, Bear Stearns blows up, and then you got to go all the way to the fall of 2008 for Lehman Brothers to blow up and catalyze the destruction of the entire global financial system. So again, I don't know that we're early in the process of crypto, imploding as evidenced by Ethereum, down another 4% today. It's off 38% month over month, down 67% in the last 3 months. But we are still we aren't necessarily late in the process of these liquidations and potentially how they may catalyze incremental liquidations as the price continues to go lower. Think MicroStrategy, my man, Mike Saylor, et cetera. And then one last point on this Ethereum being down 60, off by 2/3 in 3 months. I said specifically, I want to say in March of this year on Pomp Show, and I'll be on there tomorrow to provide the latest updates. Someone asked me a question, or is the best case to dollar cost average? And I said, why in the hell would you dollar cost average if you think something's going to get cut in half or more? Specifically, I said that about Bitcoin. Obviously, Ethereum is a higher beta token. And so to me, I think this concept that you can just dollar cost average your way, into perfection is a bill of goods, quite frankly. There are times to buy in size, and there are times to sell in size, and there are times to do a whole lot of nothing. If you did a whole lot of nothing instead of dollar cost averaging in Ethereum, you would have lost, 2/3 of your money in that trade in the last 3 months. I mean, that's a really, really sharp decline over a short period of time. So I just want to remind everyone, there is certainly a different way to do things, and we certainly think we are doing it differently at 42 Macro. I also happen to think we're doing it better. Got a lot of wonderful comments on Twitter last night and this morning, just about how we're really helping folks, achieve some real world outcomes. Folks getting jobs on the buy side. Folks saving their retirements, folks, going on family vacation because they didn't blow up their portfolio, folks saving their kids' college tuition. And obviously our friends on the buy side, our clients on the buy side are obviously enjoying much better years than their counterparts. So I'm very proud of that. If it sounds like I'm bragging a little bit, I actually am, because, we work our ass off here at 42 Macro. I'm up every day at 4:30 in the morning, grinding my ass off till 5, 6 o'clock every night. And, it's showing off. It's showing off in the results. So let's get into the volatility, adjusted momentum signals and probable ranges. US dollar. Bullish VAM still in the middle of the range. Gold, bearish VAM still in the middle of the range. 10-year nominal treasury yield, bullish VAMs close to the lower end of its probable range. We'll see how that responds to the core PC data. In line, it will be just is what it is. Bullish VAMs, high yield CDX, high yield credit spreads in the middle of its range. S&P 500 bearish VAMs after yesterday's smackdown. A little bit more of a fair fight, but not quite. 3% upside, 7% downside. VIX neutral VAMs in the middle of its range here. NASDAQ 100 bearish VAMs, big smackdown off the upper boundary of its probable range from the breaching that on Monday. 3.5% upside, 8.7% downside. Russell 2000 bearish VAMs, somewhat not quite a fair fight. You got basically sort of 3-to-1 downside, or 2.5-to-1 downside, more or less. 2.9% upside versus 8% of downside. Bitcoin bearish VAMs getting close to the upper boundary of its probable range, or it started to back off when it got close yesterday after that sell signal. We issued a sell signal yesterday morning. Then Bitcoin from that crowding analysis, which again is a short-term trading tool. Obviously, we've been bearish on Bitcoin for a long time now, having sold all of our crypto exposure on December 10th. I believe you can go check the record books on that. We were very explicit about the bloodbath we saw coming in crypto back in early December. Minus 16% of downside, 10% of upside. Ethereum bearish VAMs. You got 12% of upside, minus 26% of downside. Shanghai Composite neutral VAMs. Now finally backing off the upper boundary of its probable range. You got 1.8% of upside versus 4.7% of downside. WTI crude oil still on the rise here. Are we going to make a lower high? I think the jury's still out, but it's certainly starting to feel like it. Sorry, I didn't mean to use the word feel. We don't feel anything at 42 Macro. We respond to changing probabilities as predicted and predicated by our litany of quantitative signaling tools. So is this a lower high? We'll have to find out and wait and see. But you got 4% of downside, 12% of upside in the probable range there. And then agriculture neutral VAMs still deeply oversold. Industrials, metals, bearish VAMs. Finally got a little bit of breathing room here. You got 3.4% of downside to the lower boundary of its probable range with 7.2% of upside. So with that, Darius Dale presenting our macro minute for Wednesday, June 29, 2022. Thank you for watching. Thank you for tuning in consistently. And we really appreciate you guys. I know everyone's not going to wind up being a subscriber of 42 Macro. Not everyone has the budget for that, but we certainly want to make sure that we're helping everybody in the Team 42 community, the global and growing Team 42 community. So thank you. And I appreciate each and every one of you. Cheers.